You're up and running, Bella. You're live.
We're good to go. Okay, well, good morning, everyone, and thank you very much for joining us for Livewire's second ever webinar. I hope everyone's doing well, staying healthy and safe, and to all those people in Melbourne, hope you're, it's not too bad down there. My name is Bella Kidman. I'm the junior editor, the content editor here at Livewire Markets, and I'm joined by Livewire's co-founder, James Marley. Hi, James.
Morning, Bella, and morning all the people on the webinar. Thanks for tuning in. We really enjoyed the opportunity to bring a few fund managers live and give you guys direct access to people who are managing money on a daily basis. So thanks for joining us. And yeah, as Bella said, hope you're all healthy and safe and happy.
So today's webinar will be assessing the month that was. We'll have a brief recap of reporting season, and then we'll go into some of the, we'll ask our equity managers a little bit about the remainder of 2020. So what we can expect from the market, what their winners and sinners were of reporting season. But before I introduce the panelists for today's webinar, I thought that it would present a great opportunity to run you through a few features of our website, which you may not already know about. And these features will just help you have a greater experience on our website. So those features will be liking and saving a wire, following stocks and contributors, and also customizing your alerts to just make it a really personalized experience. So I'll begin by sharing my screen. So the first thing that you're going to need to do is make sure that you're logged in, of course. So I'm just going to log in here. And I'll just be re-met with our home page. And I'm going to use the tab up here to search for a wire. So I'm going to type in ordinate. And I'm met with this wire here. Now, the first great feature is liking and saving a wire. So on the left-hand side here, you'll see a thumbs up button. And if I like the wire, I'm just going to press like this wire. And then I have the ability to save it. And the reason and the way I can see this is up here on this tab. I click the thumbs up button, and I'm met with my own personalized reading list. And every wire that you like will be saved in this function. Going back to the wire now, I can also follow James if I like his content. So I just click follow, and that will give me the ability to be updated every time James posts a wire. And by the same token, I can come down to the bottom of the wire here, hover my mouse over ordinate, the stock that the wire is about, and press follow. And I'll be able to be updated when a wire about ordinate is up on the site. Now, that creates a really personalized experience so that you know exactly what you're going to be reading about, and exactly what you want to see is you're going to be updated with that information. Now, another way that you can personalize the website to what you'd like to see is by pressing these three little dots next to your name, and then you'll come down to email preferences here. Now, you get the ability to decide when you receive our emails. So Trending on Livewire is the daily email that everybody that chooses to can receive this email at 6:30 every day. And that basically just wraps up the day of content on the website. And then the Livewire wrap-up emails are a personalized email, which every person that you follow or every stock that you follow, you'll be updated as to what's on the website. And you can choose how often you see that. So I hope that provides a little bit of clarity to the website, and it gives you some features so that it's a seamless experience, and so that you're really personalizing the website to what you would like to see. Now, I will continue on with the webinar before we get too carried away with that sort of thing. So we've just got a disclaimer here. Please ensure that you read that. That's really important. I'll just leave it up for a few seconds just so that everybody can have a look at that. Alrighty. Now, the agenda for today. So today's webinar, we will be looking at reporting season, as I mentioned. So we've asked our managers to sum up reporting season in just one sentence, a bit of a difficult task, but they've managed to do quite well. And then we're going to discuss the key takeouts and lessons that each of the managers have learnt throughout reporting season. Now, where that gets really interesting is we've asked our managers to look at those lessons that they've learned and apply that and have a look at their sector allocations and the changes they may have made. So we'll see what they're overweight and underweight in, and then we'll get down to the nitty gritty by having a look at what stocks and companies that have won for them and the ones that may have disappointed a little bit. So then towards the end of the webinar, you'll be able to ask questions to our guests today. So you can do that by hovering over the Q&A tab at the bottom of your screen. And feel free to ask questions at any point today, and we'll try to answer as many as we can. This is a great opportunity. We have two excellent fund managers on today, which brings me to my next slide. So the two managers we've got today is David Moberly, Portfolio Manager and Analyst at Paradise Investment Management, and Chris Prunty, Portfolio Manager and Co-Founder at QVG Capital. Thanks very much for joining us today, gents. David, let's start with you. Maybe you can give us a little bit of insight into what you do and your role at Paradise.
Yeah, sure. Excuse me. Thanks, Bella. Thanks, James. So just quickly on Paradise, we're an Australian-based boutique fund manager. We've got roughly 17 billion in funds under management. We've actually got offices in Denver, where we've got a global SMID-cap fund, San Fran, where we've got a emerging markets fund, and Sydney, where we have Australian small, mid, and large cap strategies, as well as the new long, short, or alpha extension strategy. The business was founded by David Paradise in 1999, still 100% owned by staff. And I'd really describe us as style neutral investors. You know, we think the Oz market is a little bit narrow to focus on really niche strategies, but we're definitely fundamental investors, and we think earnings and valuations matter. And finally, our culture is really solely focused around performance. All we care about is the numbers, and there's a lot of alignment. So our bonuses are basically tied to performance fees. I've been with the business since 2012, initially starting as a small mid-cap analyst. I've actually worked across most sectors in the market, and I'm also running the long-short alpha extension strategy. I used to work actually on the sell side as a small-cap analyst at Macquarie prior to Paradise, which is actually when I met Chris from QVG. So we've known each other for a long time, and I'm actually quite looking forward to the discussion today.
Fantastic. Well, Chris, it's a big name to live up to, apparently. Can you tell us a little bit about what you do at QVG and a little bit about what QVG does?
Yeah, sure. Thanks, Bella. QVG Capital was founded by myself and my colleague Tony Waters in 2017. We have two products, a long-only small cap fund with about 550 million under management, and we have a long-short hedge fund that's all capped with about 60 million under management. Tony and myself really made our name running the Ausbil Microcap Fund. We did that from 2010 to 2017, returned 25% CAGR net there, which gave us the ability to start QVG, and you know, we've continued a good, albeit not as good, track record since then. Like David, Tony and I were both also on the sell side as stockbrokers covering small caps. That's really our area of expertise in the market, and you know what we're going to talk about today.
Fantastic. Well, you've heard it here first. Great guests to have on for the panel today. All right, let's get into it. So, David, I'll start with you. When we spoke last week, you said that if you were to wrap up reporting season in one sentence, the two words that you would use would be less bad. So, what does that mean, and why is that the case?
Yeah, sure. So this last reporting season obviously covered the COVID impact period, which meant the market expected a pretty awful reporting season. Estimates coming into August had market EPS to be down around 19%, which is one of the largest declines since around 1992. We actually came in down around 20 in the end, which was, while it's bad, it's largely in line with the level of downgrades which had been put through and pretty much already priced by the market earlier in the year. So it was volatile as always. However, in terms of high profile blow-ups, it was probably a few less than in recent periods. And I think the balance sheet repair and cost out work done by the corporates was pretty evident. Management were generally pretty conservative, consistently highlighting a lack of visibility in the outlook. Very few companies gave FY21 guidance. However, I think CapEx costs and dividends you could see were all cut, and dividend cuts, you know, were some of the largest on record. So in terms of the outlook, the market's now looking for about 5% EPS growth in FY21, which was actually upgraded over August. However, that was largely a result of iron ore and other commodity mark-to-market upgrades. So excluding that, growth expectations are largely flat and weren't really changed.
David, we've got the slide that shows the blue and the yellow wiggly worms that no one will know what it is straight off the bat. But you said that this was an interesting slide to talk about those future earnings expectations for the market. Could you just talk people through what they're seeing on the slides at the moment and why, sort of what it's actually saying and why it's important? Yeah,
for sure. So the lines are basically earnings expectations or EPS growth for a specified year. And at the start of the year is the top of the line, and at the end of the year is the bottom of the line. And as you can see, analysts are generally pretty glass half full. Generally, most sell-side analysts are positively skewed, given there's a number of reasons for that, which we don't have to go into now. But I think you tend to see them start at the top left and end at the bottom right. And there's only been a few periods where the market sort of underestimated bounces, and that was particularly coming out of quite after periods of distress, like what you saw in 2010 after 2009. So typically, I would say the market or analysts tend to underestimate operating leverage on the downside, and they also underestimate it on the upside. So as you can see, that FY21 period basically has had a little reprieve at the moment, but that last little step up from 0 to +5 was largely, as I was saying, as a result of iron ore mark-to-market upgrades, as opposed to any fundamental change in the outlook. So excluding that, there's no growth forecast in the market for the next 12 months? Yeah, at this point, for the ASX 200, that is, the market's not expecting any growth this year. And you've mentioned you have a view that the analysts can be too bullish in good markets and too bearish after difficult markets. Do you feel like that's a realistic, do those expectations align with your own views? Yeah, I think at the moment it's just very hard to know. So most of the companies we're seeing, they don't really have a strong view on the outlook, and they're really reliant on very short-term trading. And I think you're seeing that in the response of share prices at the moment. So any sort of short-term positive trading has been reflected into share prices, and any negatives similar. So I don't think, unfortunately, we're in a period of uncertainty, and until we get more clarity on what the economy looks like, potentially post-stimulus rolling off, and a few of these other support or crutches coming off the economy, we're not going to really know what the underlying run rate is for some time.
All right, fantastic. So we'll move on. Chris, when I asked you the same question, your response was only one word. That was forgiving, with a side of Clint Eastwood. So what was so forgiving about this reporting season?
Yeah, well, I should explain Clint Eastwood. He's there because that's the movie poster from the movie Unforgiven. And I chose to describe reporting season as forgiving. Good results went up, and results of COVID impacted companies, even if they were somewhat disappointing or would have been considered disappointing, still rallied. Part of that was short covering, but I think a bigger part of that was some pretty significant balance sheet repair. So what we saw, as David described, was CapEx was cut, dividends were cut, but the other factors that helped that balance sheet repair, which may be less sustainable, were things like big inventory draws and working capital improvements. So we actually saw some pretty poor earnings quality out of some companies, but the cash was there. Those earnings were more than cash backed because companies were benefiting from selling through their inventory, not necessarily repurchasing in time to preserve their balance sheets, and had the benefit of JobKeeper in some cases and rent abatements or forgiveness in other cases. So some of the companies in the media and travel space that we expected to deliver poor results at a P&L level certainly did that, but in terms of their balance sheet and cash burn, it was less bad, and the market was willing to look through it and re-rated those companies quite powerfully. In terms of management commentary, David mentioned one of the U's. There were 2 U's. It was unprecedented to describe what they'd experienced in the 6 months, and then uncertain to describe, the outlook for the next 6 months. So, we're starting as professional managers who, are looking to deploy a lot of capital. We can't have a trading mentality. So we've really got to look out 6, 9, 12, 24 months and think about, what happens when these companies have to rebuild their inventories, what happens when JobKeeper rolls off, what happens when landlords and banks want to be repaid, and that's why there is so much uncertainty.
We might get into those sectors in more detail just a little further on in the webinar. We've got some parts where we can talk about how that translates to the portfolio, but maybe keep us rolling through, Bella.
Absolutely. So David, a key lesson for you was that it's hardly ever in the price. Now, what does that mean? And can you maybe share why that was such a valuable lesson for you?
Yeah, so I was going to say it's never in the price, but we never say never. So we change it to hardly ever. And I think the point I was trying to make was that, and I think Chris actually touched on a few of these points, but despite some really strong moves into reporting season and into the results, a number of, particularly in those key beneficiaries around the coronavirus period, talked to strong trading in July. And that was enough to see them continue to outperform. And so, a lot of these stocks, particularly in the retail sector, did really well despite really strong results, strong performance coming in. And similarly, a number of beaten up stocks that still had headwinds but showed an ability to either have less cash burn or less losses, for example, were able to bounce really hard, and like we saw in the travel names.
What are a couple of examples of those, David, stocks that ran hard and kept running? Could you give people a bit of a feel for some of those COVID beneficiaries?
Yeah, so JB Hi-Fi was probably a good example. Like they've done really well over the period, and despite some of the broader lockdown measures, management have able to execute really well, and they've been the beneficiary, I guess, of quite a small window of spend. And I think, we can go into it further if you like, but I think the key point there is that despite having the share price benefit of the strength of that trading into June, they were still able to perform strongly coming out in August. JB Hi, for example, printing 40% like for like post balance period. It's a remarkable result for a company that's relatively mature in its offering.
Right, we'll continue on. Chris, Winston Churchill isn't somebody I would automatically affiliate with reporting season. Maybe give us some insight into a lesson that you thought was valuable coming out of reporting season.
Yeah, well, I've stolen the Winston Churchill quote, you never let a good crisis go to waste, because I think what we learned out of reporting season is that great management innovate, and even in very difficult markets, and you really couldn't, think of a more difficult market than COVID, given how quickly it impacted some businesses. Great management find a way to win, even in those tough markets and businesses that are, front and center to be impacted. So we had companies where we were talking to them through the February reporting season saying, we're fine, no impact. Then we were talking to them early to mid-March, and you could see the fear in their eyes and sometimes hear it in their voices, and then talking to them again late March, early April, where they'd had a couple of weeks to get their arms around the issues in their businesses and the issues with their balance sheets. And it was the mindset in the good companies went from holy shit, we're going down, to holy shit, this is an unbelievable opportunity to take market share, to acquire distressed competitors, or just to, enact the kind of business process and cultural change that might have otherwise taken a couple of years, because the mindset of employees and suppliers and other people in that business network in a crisis is that is very accepting of change, and good companies were able to take advantage of that mindset to, in some cases, bring forward programs that might have happened, not have been a priority, but were going to be enacted 18 months, 2 years down the line, or to enact dramatic cost reductions and margin improvements. And we saw that in our portfolios, even in companies that were heavily COVID impacted. So the lesson for me was good management, find a way to win, they will innovate. A second lesson was the value of predictions coming up through reporting season. You know, expectations were that it was going to be a tough reporting season because of the COVID impacts, yet small caps finished up 7% for the month. Large caps were up 2.5%. You know, we had AASB 16 accounting changes. We knew directors were absolved of their responsibility to you know, maintain continuous disclosure and even give guidance. So there was a lot of uncertainty going into reporting season, yet it, you know, really delivered for shareholders. So one of my takeaways was don't make predictions, because anything can happen, and it's probably more important just to play the ball as you see it, rather than try and get too far ahead of yourself.
Just on your first point, Chris, can you give us a name or two of management teams that really impressed you? Like who had a really tough wicket in front of them and really moved quickly? Where are some of those organisations with that great culture?
Yeah, well, the one that's front of mind, because they had a double COVID impact, was City Chic. So they're a plus size fashion retailer, and they were initially impacted. If you go back to February, people, ourselves included, thought that COVID was a China issue, and therefore it was impacting supply chains, and we had felt and hoped that it would be limited to a supply shock. Clearly that assumption was wrong, but in City Chic's case, they were having problems getting stock out of China. So that was the first impact that they had to deal with. They found a way to do that, diversity of supply, moving stock between e-commerce channels and stores and so on. But then they had a second impact, which obviously was store closures at one level, and then the hit on the consumer at a second level. So they were able to navigate COVID by rapidly changing the categories which were hot. So, you know, dresses pre-COVID were a huge category for City Chic, especially formal dresses and dresses that women wear to go out, but no one's going out. So they really had to ramp up other categories such as casual wear, lingerie even. Who knows what goes on when you lock down under COVID, but that was a huge seller, I'm told. Pajamas, people stayed in their pajamas all day in COVID. So they were able to respond very, very rapidly to changing consumer behaviour and reorder stock that was moving, such as casual clothes and pajamas, and push those to their customers whilst you know, reducing reorders of dresses, given they're, you know, very unlikely to sell in this environment. So that's just one example.
Right. Well, Bella, why don't we move on to the way forward?
Yeah, the good stuff. So sector allocation, David, we'll start with you. So based on what you've learned throughout reporting season, let's look forward now and talk a little bit about your sector allocation. So what are you overweight in? What are you underweight in? You know, what is looking good in terms of which sectors are looking good? What are you trying to avoid? Just give us a run through of it.
And David, maybe also just wrap in some of the information that you took from reporting season and how it flows into the way that you're thinking with your portfolio at the same time, if you could. Yeah,
understood. Yeah, so I think one of the standouts for me in terms of reporting season and looking through the sectors was really the strength of that consumer. And there was clearly a lot of stimulus thrown that way in terms of direction. We had JobKeeper, Job Seeker, and in some cases this meant that recipients were actually paid more than what they were when they were working. And when you add on those super withdrawals on top, the amount of money into that segment was really large. So couple that with the fact that there was a lot of categories that were restricted in terms of where you could spend your money. And for example, you had categories like travel, which historically is run at potentially around 100 billion on an annualized basis in Australia. It's basically a third of all of retail trade. All of that needed to be squeezed into a few categories that were open over that period. So at the stock level, I think the trends were relatively clear, with home improvement or work from home and home entertainment categories all doing really well. So in some of the larger names like Wesfarmers, you saw Bunnings have a huge result. In mid caps, like a company Reliance with its plumbing supplies business in the US, JB Hi-Fi, as I mentioned before, Harvey Norman, Nick Scali, these companies all had really strong results. And it was also evident in some of the mid-cap names, like car usage was also looked like it was up. You know, auto-related stocks like Burson and ARB Corp also did really well. I think for me, the challenge is from here, whether or not these activity levels can be sustained and how much is actually being capitalized into the share prices already. So the one we mentioned before, you know, JB Hi-Fi printing a 40% like-for-like in July from a mature retailer is actually a huge number. And I think investors at the moment are really playing a bit of a game of pass the parcel at the moment. And potentially AGM comments, I think, will remain pretty strong or robust in these stocks. However, you know, moving forward, it's going to be pretty difficult to cycle these results at some point. And most of them are actually currently at record valuation. So I think you need to be pretty cautious being long the last upgrade in a cyclical stock like that. And we're pretty cautious on that part of the market. Another trend, you know, e-commerce, well documented, you know, was also pretty evident in the Australian reporting season. And I think that's somewhat shifted the balance of power around, you know, landlords and tenants. And so you saw Goodman, for example, great result, positive outlook, and commentary around expansion plans with key clients like Amazon. But some of the retail landlords like Centre Group and Vicinity Group took decent write-downs on their retail assets, and they've still got a number of clients on rental abatement at the time of the results. So, you know, and in the mining space, you saw iron ore and gold obviously doing really well, whilst coal, you know, struggling. So we didn't actually make huge changes to the portfolio over reporting season. There are a number of stocks where we've topped and tailed, but the core positioning is pretty stable. And for us, those top three overweights are industrials, materials, and staples. However, that's just the GICS code. And at the end of the day, there's stock-specific views in those categories as opposed to a major sort of top-down overlay. And obviously, we're active managers. So, you know, these views are subject to change at any point in time. However, in industrials, one of the stocks we like is Atlas. Atlas is showing really good progress around traffic recovery in France, and it's also got a really strong balance sheet and great management. But there's a number of stock-specific drivers, including upside to distributions and optionality around future growth projects, which we like. So it's not just about being a toll road. And in terms of the materials, the overweight is still in gold. I know we've spoken about this before, James, and you know, gold's clearly benefiting from central bank money printing. But again, we like Newcrest, which is delivering a huge amount of free cash flow at the moment. But there's a number of, again, stock-specific drivers or issues around the production outlook, which we think could see a re-rate in the stock in terms of valuation. And then on the staples side, Woolworths is the key stock there. Like, the market's been quite disappointed in the additional costs that were put into the business and somewhat offset the benefits or the additional sales as a result of COVID. We think a large portion of this was pull forward investment, and moving forward, you will see a significant portion of operating leverage return to that business, and the outlook commentary in the most recent result actually confirmed this to be the case. So the stock's actually trading at one of the lowest premiums to the market in the last few years, and we really like it.
David, just on healthcare, it's obviously a really topical sector given the current environment. I can see you've got a good allocation there. I know it's one of your specialties. Could you just talk us through what's in the healthcare space? And I know you talked about some of those beneficiaries from COVID, the JB Hi-Fis and the retailers, and potentially some of the, maybe the value's not there anymore. Is the value still in that healthcare sector, which is obviously a beneficiary in and thematically favourable in this environment?
Yeah, so healthcare is similar to a lot of sectors in our market. It's really bifurcated. So you've got a number of stocks that have been impacted by COVID and a number of stocks that have been beneficiaries. We're long a couple of names in healthcare, CSL and Ramsay. And in the case of Ramsay, it's probably counterintuitive that a hospital operator would actually be impacted through the COVID period, but their capacity was actually was taken by the government for fear of what would happen if emergency departments were overfilled. So they actually were significantly impacted over that period, and elective surgery, as we know, was shut down. So Ramsay's in the process of recovering those volumes. And if you look at Australia, pretty much everywhere other than Victoria is back to growing on PCP. And it's one of the few stocks, I think, where it will have true pent-up demand. So it's not a case of just turning back on and returning to a run rate. But for example, if you needed a hip done prior to COVID and it hasn't been done, that backlog of work still needs to be worked through. And CSL is another one that we can go through in a bit more detail later, James, because I think that's one of the stocks that was in our impress list.
Right. Want to move to small caps, Bella?
Righty, Chris, same question to you. What lessons have gone into practice? What are we seeing in your sector allocation?
I actually think David gave a really good summary, and you can extrapolate a lot of what he said down into smalls. The comment I'd make out of reporting season and sector positioning is that a lot of the beneficiaries, we'd question how sustainable the tailwinds to those businesses are. A Harvey Norman doing the comps they're doing is clearly unsustainable, and they will struggle enormously to cycle that. Now, Harvey Norman's, it doesn't appear to be in the price. It trades pretty cheaply. Perhaps people are worried that Jerry's a bit mad, and he probably is, but my advice, or not that I'm allowed to give advice, but the way we're approaching the world is we're trying to figure out how these businesses were trading pre-COVID, what's been an artificial boost, and what they're going to look like in the future. So clearly there are some COVID impacted businesses, and an example that we own would be something like Tyro, which does point of sale payments terminals for cafes and the like. And their Victorian metro volumes are down big time, but the shift from cash to digital is a persistent trend that had been in place pre-COVID, is likely to be accelerated post-COVID. And Tyro has a good stock-specific story because it's taking share from the banks, who are the incumbent, often the incumbent point-of-sale providers. So the way we're thinking about things is to go back and look at the 6 months to December 2019, for example, and see how some of these businesses, what was the underlying trend in these businesses. And David mentioned retail landlords as a particularly impacted sector. The scary thing for them is they weren't trading well pre-COVID. So how do you get excited about those businesses in this environment? It's just accelerated their decline. To use a higher quality example that surprised me, Auckland International Airport, monopoly asset in New Zealand. No one is going to argue that isn't a great asset. It's got enormous latent value in the land around the airport, and it's really the only way to get into New Zealand, and it will recover. But the challenge for that business is international passenger numbers. If you look at it, were down in the 6 months to December prior to COVID. So, peak New Zealand, I don't know, but something was going on in that business that suggested the trends weren't supportive even before the coronavirus impact. Another example domestically, InvoCare. So obviously death numbers are down in aggregate because of COVID, but they weren't trading well. Again, another business not trading well in the 6 months to December, even the whole of last calendar year, that business had been trading poorly. So I think you can really simplify some of the analysis and just go back and have a look at, calendar 19 for a lot of these businesses and see what was happening. And clearly there's been a massive pull forward for anything to do with the consumer, anything to do with work from home. That enormous pile of money that would have gone on your international holidays found its way into motorbikes and couches and TVs. That is not going to be sustainable. The other area of caution where we've really shifted our portfolio is small financials. Very hard to get your arms around on the bad debt experience that these companies are likely to have in next calendar year. We know the banks have been told to hold back. Small financiers are probably benefiting, if anything, from super release. But what do their loan volumes look like next year? What does the bad debt experience look like next year? Very hard to know, and therefore very hard to value those companies. So you can see on the slides, we had the GICS classifications, which I don't think are particularly helpful, but often it's better to talk in thematics. It's a bit more illuminating. So we are skewed to what we consider to be defensive growth segments or thematics, including digital payments. I gave Tyro as an example. E-commerce, I talked about City Chic before. We also like the junior telco space. There's a long history in the Australian market of mergers in the junior telco space, which create real synergies due to networks, often due to network synergies. Like David, we like gold. We take a diverse approach because there's often stock-specific risks in gold. So we think about that just as one position, albeit made up by a few companies. And unusually for us, given it's somewhat cyclical, we have a bit of a tilt towards agriculture at the moment. After 3 years of drought, the drought appears to have broken, and there's some good bottom-up stories in the ag space.
Can you give us just talk us through a few examples underneath those sector headlines for us, Chris? Just give us a bit of an insight.
Yeah, so in payments, one stock we like is EML. EML, I would class as a COVID victim because still a big chunk of their earnings is gift cards, which they sell in Europe and the US. So no one attending malls and quite an uncertain outlook for mall attendance at Christmas, where they do 40% of their volume in the 4 weeks before Christmas, means that their earnings for this financial year are almost certainly going to be impacted, and the market is aware of that and has marked the stock down on that basis. But the other part of their business is providing card issuance to disbursement of funds for governments, which is very defensive, and a lot of the neobank startups, especially in Europe. Neobanks and fintech banks are not that prevalent in the Australian market, so it's a bit hard for Australian investors to get around just how much growth these companies are seeing. But in Europe and the US, where there's a much larger unbanked part of the population, these bank startups are taking enormous share, and EML is a provider of cards, digital cards to them, and payment processing and card issuance. So that is a business that in its non-gift side is growing at 20% plus, very high gross margins, very high operating leverage, albeit you're not going to see it this year because of that hit to the gift business. E-commerce, we spoke about City Chic. That's quite a large position for us. What I didn't mention before was that they've used COVID to acquire a business in the US, which out of bankruptcy protection called Catherine's. City Chic already had a presence in the US earlier, and they had acquired a business called The Avenue. The great thing for them is that Catherine's is a much less distressed business than their prior purchase of The Avenue, and it gives them real scale and further customer acquisition in that US market. Again, we don't think the market fully appreciates the margin opportunity for City Chic and the earnings power of putting these businesses together. The market really hasn't seen a clean year of numbers out of City Chic, so the range of analyst estimates is very wide. But we think the operating cost base will come in a little bit lower than the market thinks, and obviously there's an enormous tailwind to e-commerce generally and City Chic specifically, which we think they can harness. So there's a couple of examples for you.
Bella, why don't we jump into the winners and the sinners?
I think that's ideal. All right, the moment everybody's been waiting for, let's get stock specific, the winners and the sinners. Okay, so I'll start with you, David. CSL, Australia's biggest company, had an outstanding result over reporting season. Tell us a little bit about why this is a winner for you, and what the future prospects are for the company.
Yeah, sure. And please cut me off, or I can tend to rabbit on about this stock at times. So please cut me off if I go too long, or if you want me to.
Before you dive in, we want to give viewers a chance to ask some questions. So we might, for those viewers that are online, if you want to start sending through your questions, why don't we keep it relatively punchy here on your winners and the sinners, and then we'll get some questions through from the audience as well. So give yourself a few minutes to talk through your key points.
Yeah, sounds good. So the result itself was sort of slightly ahead of guidance, but I think the key reason why the stock performed strongly on the day was the market really took confidence in the fact they were one of the very few companies that was able to guide to growth. So they provided guidance, and the guidance suggested that they could continue to grow despite having a few headwinds, and they actually gave some visibility around the business. So I think, for us, that was the key reason why the stock was strong. In terms of the outlook from here, we've obviously got an eye on the short term in terms, when we look at position sizing, and the big issue for the moment for the stock and the biggest overhang has really been concerns around the decline in blood donations in the US because of COVID restrictions. This is obviously a short-term issue in our minds and not expected to have a sustaining impact on the business, but I think we're also tracking a number of big data sources to track mobility around collection centers in the US, and we want to be the first to know basically when they've actually seen that improvement, and we actually are seeing that improvement now come through. So we're watching this very closely as a potential catalyst for a further re-rating in the stock.
Well, let's stick with your winners. IDP also had a bit of a bounce after reporting season. So what are the future prospects for that company, and why were they such a winner?
Yeah, so IDP was another stock performed very strongly around the result. This was a bit of a different example actually, where visibility on the company is still quite low in terms of revenue and when it returns to their key businesses in international student placements into universities and their IELTS or high stakes English language testing business. But the stock was strong regardless. Firstly, as I think Chris was highlighting before, this was one of those examples where the strength of management was really evident in controlling what they can, which was cost, cash flow, and the balance sheet. So basically they reduced cash burn to lower than what the market had been expecting. Costs were also reduced, and the balance sheet has been set up to withstand that duration of disruption. So they were also able to demonstrate how strong the demand profile or the backlog is, and we saw an incremental improvement in activity levels where it's been possible, i.e. where they've been able to open up. So IDP is one of our key, small or mid cap exposures, and it's interesting for a number of reasons to us. Very high quality company, consistently delivered very strong returns with minimal additional capital required. They've got a great management team, but also I think, we'll touch on this later, but this is one of the names that will be highly leveraged to a vaccine outcome. with a balance sheet that's basically strong enough to withstand any delays or time frame of recovery.
Chris, winners before sinners, John's Ling Group, arguably a very interesting company with quite a boring name. Can you maybe talk a little bit about reporting season for this company and why you're attracted to the company?
Sure. I think it's a boring company with a boring name, but most people won't know Johns Ling. What they do is repairs on behalf of insurers. So if a tree falls on your house, or you flood your bathroom, you call your insurer and they send out someone to fix it for you, hopefully quickly. And Johns Ling are the largest provider of those sort of insurance repairs in Australia. And the great thing for Johns Ling is the quality of management and the culture within the business. So they have a particularly fragmented competitor set, which means that in their industry, I would describe them as the tallest dwarf. They are really the professional operators that insurance companies like to deal with, because they know they're going to get consistency on the work and price, and the culture within the business is outstanding. It's one of growth and rewarding people. So they didn't have it all their own way. They did have some COVID impacts. They've got a shop fitting business that obviously no one's fitting out new retailers. They are a business that's overweight in Victoria as well. They've got a commercial construction business that was impacted. Having said that, they were a company that found a way to win and actually were able to upgrade their earnings twice. They were able to not let a crisis go to waste and really relook at their business in terms of costs and margin, and delivered an outstanding earnings and cash flow result, which means their balance sheet is now in great space to potentially make acquisitions.
Okay, Chris, sticking with you, Hanson Technologies also seen quite the bounce. Talk to us a little bit about that company.
Hanson, another a boring business. It does billing and metering software for telco and utilities. The great thing about that is those systems are incredibly sticky. The bad thing about that is those systems are incredibly sticky, which means it's very hard to win new clients. So their organic growth historically has been very low. Having said that, they have reinvested in their products over the last few years and showed, even despite COVID, showed some good organic growth in that second half. The thing I like about Hanson is the track record of management, again, in terms of capital allocation. They've done a great job at acquiring businesses and getting their margins up, and used COVID to accelerate some of that margin improvement. So their margins, second half on first half, increased 430 basis points, which is significant and gives them an excellent run rate into this financial year, and that's why the stock re-rated so aggressively, is that margin expectation.
Right, David, they can't all be winners. Let's talk about Telstra. It seems like Telstra just continues to disappoint. So why is this such a sinner for you? And do you ever think that Telstra will see its glory that it once had?
Yeah, so Telstra missed expectations by what was probably only a fraction, but the real issue why the stock was weak was around FY21 guidance, which came in about 7 to 8% below consensus. FY21 forecast had recently been boosted around, I guess the market's been expecting an improved mobile pricing environment, and it hasn't really eventuated despite some changes in the industry, which should have resulted in more rational behaviour. Roaming revenues also evaporated given a lack of international travel, which we don't think is likely to come back in the short term. And positioning the stock, I think, was also quite long, given that it was a defensive in this COVID environment. And I think that obviously turned out to be wrong. And
what about AGL, another sinner for you?
Yeah, AGL downgraded earnings in August, with COVID accelerating some of the pre-existing headwinds that the business was seeing, including gas contracts that are maturing, falling wholesale electricity pricing, and you also saw some additional costs from customer hardship. So mostly a lot of these are external issues that are evident in the markets they operate in. And Origin actually saw the same issues in its energy markets business, but on a positive note, management are continuing to do what they can in terms of managing the cost base, and the balance sheet is actually in pretty good shape, which meant they were able to increase the payout ratio.
Chris, let's go to you for your sinners. Something that's been giving you a headache, Webjet. Talk to me about Webjet. Do you think it's just temporary? Is it a forever thing? What do you think?
The reason I wanted to highlight Webjet is actually an unusual reason. They expanded their shareholder base by 40,000 in the 12 months, over 12 months from June to June, and from 15,000 shareholders to 55,000 shareholders, which is a staggering number for a company with a $1.3 billion market cap. Usually you would expect, that many shareholders in a top 20 company. So what that tells me is that a lot of retail shareholders have bought Webjet in the last 12 months because the share price is down, perhaps not realizing a few things, one of which is that they've raised capital through equity and debt, so shareholders have been diluted, so it's unlikely to, in share price terms, to return to its previous highs. Also that they have shuttered businesses that contributed to previous earnings. So at a $1.3 billion market cap, even assuming a generous 20 times earnings, you are expecting Webjet to go back to 65 million NPAT, which is more than they made in FY19. And that FY19 included businesses that have since been closed, including their cruise business and a business in New Zealand. So I just wanted to highlight that as one that scares me, and one that I, delivered an incredibly downbeat outlook from a CEO who is, used to being quite upbeat. He sounded quite dour on the call, so that one scared me.
And EOS, giving everybody a bit of a headache. Why is your vision tainted for this company?
I think, boys like toys, and EOS is the ultimate toy stock, along with Austal, which makes boats. But EOS is even more exciting because it makes gun turrets and unmanned gun turrets. So if you go and watch their videos on YouTube, it just looks really cool. And they're from my hometown, Canberra, so I shouldn't bag them, but I will, because they burnt $88 million in the 6 months to June and raised $202 million in the last 12 months, which is just a staggering amount of equity. It's a staggering cash burn. And the thing that I would highlight with EOS is that for some reason, their cash receipts from customers doesn't go anywhere near to matching their revenue. So there's a few red flags in there, and it's one I'd steer clear of.
Alrighty, well, I'm conscious that we are towards the end of the hour. So thank you to the people that have submitted the questions. While we're just collating those questions, I just wanted to spend a little bit of time talking about valuation. So David, you sent in this little image for us. So can you explain what this is and why this is important?
I think actually, thanks, Bella. We had a few questions around that have focused on valuations and around this concept about switching from growth to value in these high growth, well bid names, and if it's a good time to rotate. So maybe, David, if you could talk us through this, and Chris, just give us your view on that. And then we do have quite a backlog of questions, so I'd love to do a quick fire on some of those questions for you, if we could touch on this valuation topic, and then we'll get into a couple of the questions from our audience.
Yeah, so for sure. That chart's just trying to highlight, I think, how narrow the rally in markets have been. So as you can see there, that's the percentage of the S&P 500 market cap of those top 5 companies. And in the prior peak, which I wasn't actually around for, I was too young, but to be working in markets. But back in 2000, we had the tech bubble, and the top 5 companies in the S&P 500 got to about 19% of the total market cap. And at the moment, this chart's 1 week old, so it's obviously slightly out of date, so it's come back a little bit. But you've got Microsoft, Apple, Amazon, Alphabet, and Facebook now at about 25% of the market. So I think we're just trying to highlight there that the depth of the rally has been very, very narrow. And it kind of ties into what James was highlighting there, that there's been a huge outperformance by growth over value. And maybe we can go into that in a little bit more detail.
Chris, have you got a view on that growth versus? Oh, Bella, you just want to roll through the next slide for us? Is this the slide you're referencing, David?
Yeah, so just the one back there. Yeah, so basically that's just value performance versus growth in that red line, and that blue line is actually the shape of the yield curve. So typically, when you see a steepening yield curve in the bond market, it's investors are thinking about either inflation picking up or growth picking up, and you see an outperformance of value. And sometimes that can actually be in periods of down markets where growth actually just drags the whole market down, but value actually outperforms. And you can see how many years now that growth is actually been outperforming value, in particular in the last 5 years through this central bank money printing period where growth has had huge outperformance. And I think the reason why I brought it up is our current view on markets is pretty cautious, but we actually think that active management or alpha, we're bullish on alpha or active management despite being a bit cautious on overall markets, because despite having pretty full valuations and a significant amount of risk, geopolitical risk, whether it be US elections or China, what Chris just highlighted before, we've actually seen that across the whole market, record retail involvement. And then finally, the second derivative on a lot of these things that have been supporting markets, like activity levels or data improvements now starting to stall, and stimulus is still there, but incrementally reducing, and Fed balance sheet, for example, no longer growing. So I guess what I'm saying is a lot of those things that have been supporting markets during that period of stress aren't increasing anymore. But we think there's still going to be some opportunities, particularly in some of these stocks that have been undervalued, and where you can see a catalyst potentially over the next period with a COVID vaccine or additional testing or treatment options. So I think a vaccine or more immediate testing would clearly have huge implications for some of these sectors or stocks that have been like massive relative underperformance. And have lagged quite materially. So any rotation out of the stocks that have been winners into some of these laggards like transport or leisure or entertainment or energy could see quite material alpha opportunities, I think.
Alrighty. Listen, we might, we're really tight on time, so we might just rip through a couple of quick fire questions. Chris and David, I'll get you guys to jump in and keep them short and snappy. We'll try and get through a few. For those that have sent questions, if we're not able to get to them, Bella's going to write an article, and we'll reach out to the team and give you a response in that article. We'll try and cover some of the topics that you've raised, so bear with us. Chris, quick question for you. Examples on stocks in the ag sector. Is there anything specifically catching your eye? And someone's asked if you have a view on Tassal Group.
Yep, the two agricultural stocks we own are Elders and GrainCorp. GrainCorp has a tortured history, but it's spun off its malt business. It's got no corporate debt on its balance sheet, and we think that the earnings power of that business is underappreciated by the market. Elders has been a much better performing business, albeit again, we see upside given much more favourable conditions, especially in the next 12 months. And they've made a couple of acquisitions that haven't contributed for a full period. So those are the two we like. Tassal, actually, David and I visited Tassal in 2010, went down to Tasmania. It was a great trip.
Back in the good old days.
The good old days, but I don't think, I don't want to speak for David, but I don't think either of us walked away from that trip thinking that Tassal was a great business. It's incredibly capital intensive, and when you go down there, you see where the capital's going. And the thing that surprised me over the years is just they keep on spending capital, and they generate incredibly low returns on that capital. So and you get the usual agricultural risk. So looks unattractive to me.
Okay, David, a couple of quick ones for you. Has all the good news in CSL been brought forward? So mediocre returns from this point. And then the second question was on AGL, which is a stock you discussed. A question around, given that it's been a bit beaten up, is it now looking cheap?
Yeah, so firstly on CSL, no would be the answer. The stock's actually, after a strong performance around the result, the stock's actually drifted back and has underperformed the market for the last 3 or 4 weeks. And if you actually have a look at it versus the other healthcare names, some of which are very expensive, it actually looks attractive relative to the market and relative to those other healthcare names. And I think from my perspective, if you see continued improvement in the collection outcomes in the US, there's a fair bit of upside in terms of earnings compared to market expectations and company guidance. So I don't think so in terms of my view on CSL. And the second one, in terms of AGL, we're still sitting on the sidelines waiting to see some of these issues play out. I think some of those headwinds that we referenced earlier will be persistent on the industry for some time.
Okay. Chris, a couple more coming through for you. EML has underperformed relative to the buy now, pay later stocks. Does the trend continue?
That's asking me how to view on both sides of that trade, which is incredibly difficult. The thing I'd say about EML is it's quite clear why the market doesn't like it, and it's quite clear why that's a temporary issue. So we think it's a good bet from here. Whether it outperforms or underperforms the buy now, pay later stocks is a very difficult question to answer. The thing I would say on buy now, pay later, given it's so topical, is that there's actually quite a wide disparity of business models in the buy now, pay later space. Buy now, pay later has become a catch-all term which includes some businesses which are genuine credit providers, not shorter-term installment providers. And the economics and risk profile of some of those businesses are quite different to, say, a pure play like an Afterpay or a Sezzle, where the installments are shorter, the average order values are much lower. Once you start to extend unsecured consumer credit for longer periods, 12 months and the like, that's where you can potentially run into some, real bad debt problems down the track. So my advice or my suggestion would be, pick carefully between the buy now, pay later providers.
David, this one's probably for you. Do you have a preference on the domestic casino players?
Not really at this point, James. I mean, the sector's obviously been impacted heavily by COVID. I think Crown's got obviously a bigger exposure down in Victoria. So that's been impacted probably a little bit further than Star. The problem is both of these stocks, to Chris's point, had some issues coming into COVID, and they're typically the types of businesses that are very heavy on CapEx, very light on returns. So I don't have a view at this point.
Well, listen, folks, I'm sorry, we've obviously had a good long chat where we've gone over our allocated hour, and we are going to need to wrap things up. For those people we didn't get your questions, we will do a review of those in the article and get a response, and Bella will put that up later this week. And Bella, I might hand it over to you to make some concluding comments.
Oh, well, thanks everyone for joining us. Thanks to Chris and David. I'm sure our audience can agree that it was very insightful and we learned a lot. And thank you for everyone that joined us today. We really appreciate you taking the time out to come to the webinar. And if you have any feedback for us, please let us know. We would really like to continue to improve on our content. So as James mentioned, the article will be coming out very shortly. And so we hope you all enjoyed today, and we look forward to seeing you again soon.
Thanks, Chris. Thanks, David.
Thanks, Bella. Thanks, James.